in Anchorage, Alaska. It's 7 p.m. Anchorage, Alaska time, 11 p.m. Eastern. If you guys are up, I know you guys are up. It's Friday night. Y'all aren't sleeping right now, okay? So we're going to be doing on our staff training / Friday night wealth creation course. We do this every Friday night, 7 o'clock Alaska Standard Time. And tonight we're going to be talking about the different ways to invest. All right, we're going to be talking about how to, what type of investments there are, different ways you've been taught, things you maybe not have heard of before. We're going to go into detail on that. And we're also going to talk about how to ensure your success. So without further ado, a little bit of Uncle G.
There is no shortage of success. Regardless of their culture, race, religion, economic background, or social group, most people would agree that success is vital to the well-being of the individual, the family unit, and the group, and certainly to the future survival of all these things. Look, without success, your group, your company, your goals and dreams, and even the entire civilization would cease to survive and thrive. Winning over and over again at everything in which you're involved ensures you're going to be able to further expand and survive. And it guarantees that both you and your ideas will survive, not just get by, but survive into the future. If you quit caring, then you're going to quit winning. And if you quit winning long enough in this thing called success, you're going to just plain quit. How would being successful be important to you, and how would it improve your life? Look, success is needed in order to perpetuate, to push forward people, places, and things. You must never reduce success in your mind or in a conversation to something that doesn't matter. On the contrary, you must treat success as though it's vital, it's important. Anyone that minimizes the importance of success to your future has probably given up on his or her own chances of accomplishment, and is spending now his or her life trying to convince others, you in this case, to also give up. Individuals and groups must actively accomplish their goals and targets in order to carry on with their goals and targets. If not, look, they'll either cease to exist or be consumed and become part of something else. It's not enough just to play the game. It's vital you learn how to win at this game.
All right. Exactly right. So Grant, talking about how you need to take your success, you need to think your idea of what your success is, and really understand that you can't allow other people's ideas, other people's visions of what they think about success, or maybe they've put it to the side, allow it to go and diminish what you need to do in your life, which is to have success. Now, Grant also talks about in other in speeches and offices books that success has really come down to what you do, right? It's what you're doing every single day. Like getting out of bed, it could be a success for you, right? So whatever it is, like you have to continue to push harder and harder, whether it's like, hey, I just did one more thing this week, right? Because you're continuing to grow. So we're going to talk about the different ways to invest tonight with Coach Jerry Fetta. We're also going to be talking about this second Sunday. I want to put really big motion here on the Operation Reborn, which is the nonprofit organization that is sponsored and contributed by 4 Alaska local businesses here. That's going to be Sean Idem over at Hair Science and Barber School, where it's hosted at every second Sunday. It's going to be Matthew Lindsay at Precision Home Group. We got Cliff Goffner at Alaska Management Group, and our own very own Jerry Fetta here at Wealth Dynamics. For entrepreneurs, knowing that we need to fix and address the condition of the city. We want you guys to be a part of that. We're not asking for money. We don't need that. We got that covered. We want you to talk about how to spread the word about what we're doing. We're going to be feeding hot, fresh food, grooming, nice, fresh haircuts, education, how to actually sell yourself to get a job or a position that you want and you desire, and then also empowering the individuals to go out there and pursue a new job or at least a job to start with. So I'd like you guys to be part of that. Share, like, and share Operation Reborn, and be a part of that, pushing that out forward. So without further ado, the different ways to invest with Jerry Fetta.
All right, thank you, Mike. All right, so for those of you that are watching live, thank you for tuning in. We got Facebook, Instagram, a couple different feeds. We've got a private live feed. If you're on my email list, you got the link for that. But if you don't know me yet, I'm Jerry. I'm the owner here over at Wealth Dynamics. And every Friday at 7 p.m. Alaska time, we come to you live with a course on wealth creation. Okay, so last week we talked financial organization. This week we're going to talk actual investing. We've talked about income. We've talked about personal development. And so if you're tuning in live, we do this course for a couple reasons. Number one, I got to train my guys. Okay, so I got my sales team here, I got my employees, my staff, and so this is an opportunity on Friday nights. And I want you to give props to them. You don't always see them, but they're here every single Friday night. They could be out with friends, they could be out partying, they could be out, going out to dinner, doing whatever. They choose to come here and learn. Okay, so I want everyone to recognize them. This is really one of the primary reasons. It's an opportunity for me to train them. And then I also want you to recognize yourselves. You're here on a Friday night too, okay? And you didn't tune in for no reason, okay? So there's a couple groups that you probably fall into. Number one, you're seeing this for the first time. And if you're seeing this for the first time, we're going to spend an hour diving into wealth creation. All right, we're going to spend an hour diving into how to invest tonight, okay? Number two, you've seen this before. You've been thinking about tuning in. You're just now doing it. I'm glad you made that decision. And number three, you've been tuning in. This is something that's helped you. You've seen the benefit. I appreciate that. If you're that third group, I want to make sure you guys share the stream tonight, okay? And then the other thing here is we're going to go through basically investing. So if you've been considering investing, if you've been considering putting money aside, if you've got, a 401k that you've been considering moving, putting money into a deal, whatever that might be, I want you to really look at what we're talking about tonight. Take the data, look at the numbers, study it with us before you decide to invest. Okay? Really quick backstory, my story on investing, the first investment I ever made was right after my mom died. So she had a retirement account. She passed away. I was one of the beneficiaries on it. So me and Lexi got, what did we get, like $3-4 grand? Okay, $3 or $4 grand. And so I was in an insurance company at the time where we were selling term insurance and mutual funds. Okay, and I took that $3 grand. I was like, well, you're supposed to put this in a mutual fund. So I did. I put it in the mutual fund. It stayed there for like 6 months and nothing happened. It's like, man, I haven't even made back the fee that I paid when I put the money in there. Okay, then life happened. We ended up having to get a new car. We pulled the money out of the mutual fund, bought the car, and we were broke and we lost money in fees. That was my first experience with mutual funds, and I was selling that stuff. That was the product I sold. I was like, oh, I'm in the Legg Mason Municipal Bond Fund. It's going to grow with tax-free interest. Okay? So I didn't understand investing, and I was the one teaching investing. I had my Series 6. I had my Series 63. I did all of that stuff for a living, and I didn't even understand the practicality of where I was putting my own money. And a lot of people do this because they rush into wanting to be an investor. Okay, realize that's a lot like having a college degree. It does not mean anything. Like the title of investor, that's not the end result. Okay, the end result would be, what are some end results, guys? Why would you invest?
Cash.
Money, cash flow. Freedom. Ultimately, yeah, freedom. You would invest for freedom. So you'd be like, hey, I'm putting money into an investment so that I can gain financial freedom, right? And so that's really what you've got to be focused on. Nothing against, we're going to go over a number of different vehicles for investing. Nothing against any of them. Question is, does it get you free? If it doesn't get you free, it doesn't matter if your brother-in-law sells it, the guy who you go to church with sells it, Dave Ramsey said to do it, Grant Cardone said to do it, Gary Vaynerchuk said to do it. It does not matter if it does not meet your numbers. Okay? So you don't just stick money in a deal because you're like, oh, so-and-so said it's a good idea. That's not how you live your life. I hope that's not how you live your life. So I'm going to go ahead and pull up my whiteboard. Lexi, let me know when this is in the shot.
You need to bring it more towards the middle.
Is that good?
Bring it to the left more. For
My
one
left
sample.
or your left?
My left.
You're right.
Okay.
Yeah. There we go. And then we might need to bring this a little bit closer.
It's like on Napoleon Dynamite.
Here you go.
Grab my wrist.
Just
Other wrist.
Yeah, start with
My
it.
other
Make
wrist.
it toward the. It's not showing the yellow. It's so ugly.
All right, guys. And we have some construction going on back there Lexi's embarrassed about. It's
I'm pretty
ugly.
embarrassed.
It's hideous. Give him a peek.
Oh,
Can
yeah,
you show?
there you go. I
Can you
can
show?
see it. It's lovely.
Yeah, it's
Okay.
ugly back there. Now that that's out of the way. All right, so
Yeah, that's good.
investing. We're going to jump into this. Can they see on the other two cameras on Facebook and stuff
Actually,
here?
we need to bring it over more to this side, this way. For Facebook.
All right, Facebook. Can you guys see this? Insta?
Okay, they can see it.
Cool.
See it.
All right, guys. So with investing, the word investing actually means to clothe your capital. Okay, so I want you to remember that. To clothe your capital. That comes from the etymology of the word invest. All right? So a lot of times when we talk investing, like people are talking about mechanics of investing, which investment they should choose, and they don't understand the purpose of investing. To clothe your capital. All right? So to clothe your capital, I like to break it down like this. I wear clothes, obviously, right? So when I wear clothes, I'm looking for a couple of things. Okay, I'm looking for something I like. I'm looking for something I understand, and I'm looking for something that fits the occasion that I'm going to go to. So if I'm going to, let's say shovel snow, I'm going to wear something that actually fits that. Okay, I've got to like the thing too, and I've got to understand it, right? So there's certain things I won't wear because I don't understand them. There's certain things I won't wear because it doesn't get me, what I need for the occasion. There's certain things I won't wear because I don't like it. Same thing with investing, right? So when you're clothing your capital, you have to ask yourself, do I understand the investment? That's the first question. Okay. Second question, does it actually achieve the outcome I'm looking for? And then third question, do I like the investment? If you don't like the investment, why would you put your capital in it? Right? So there's certain things I don't like. I don't like pharmaceuticals. I don't like psychiatry. I don't like tobacco. I don't like alcohol. Like, those are all personal decisions, so I wouldn't invest in those things. Right? I don't like marijuana, so I'm not going to put money in marijuana. Okay? So those are things that I'm not going to invest in. But little do I know, sometimes when I was investing in the past, I would buy, different funds that had holdings in those very things that I knew I didn't like. I just didn't know it was inside my deal. Right? So clothe your capital. Again, understand the investment. You gotta actually like the investment. It has to meet the occasion. All right? Now, I want you to think about this logically. We're gonna talk timing really quick. Okay, so if you're trying to invest, which is to clothe your capital, you need to ask yourself, do I even have capital to clothe? Is there even anything there? Okay, and this goes back to how much money do you have saved. If you don't have enough money saved, then you don't have any capital to clothe. The formula, it's the cycle. Nano and I were joking actually earlier today, all of the savers are losers, and they're like, use debt, debt's awesome, no problem with debt. But when you use debt, who are you getting the debt from? And what do we decide, Nano?
People that have money.
You're getting the debt from the people who had money. The people that did save, the people that put 40% away. People talk about getting money from the bank, getting money from a credit card. The people that started those banks a century and a half ago, they saved 40% of their income. That's how they were able to start a bank, right? So when you're looking at investing, again, clothing your capital, you actually have to have capital to clothe. Our number is $50K. Okay, our number is $50K. If you do not have $50,000, you do not have enough capital to clothe. Okay, and let me show you on $50K really quick. So I'm investing, I've got $50K, right? That $50K, let's say I'm getting a 12% annual yield on that $50K. 12%, right? This equals $500 a month. Mike, would $500 a month make a significant impact in your life?
Not right now.
No, you blow through it, right?
Yep.
Nano, $500 bucks? What would you rather have, $500 bucks a month or $50K right now?
50K.
50K. So you have to ask yourself, am I even ready to invest? Okay, invest, like when you think about it, you're going to get rid of the capital. Now let's do the math on this. If you've got $500 a month, Mike, do you have a calculator?
Yeah.
So if you've got $500 a month coming in and you just went all in on your 50K, divide 50,000 by 500. And we're looking at how long will it take you to recuperate your capital here?
100.
100 months? How many years is that? Divide that by 12. It's like 9 years? 8.5 years? So it would take you 8.5 years to make your money back. 8.5 years. So if you're investing too early, this is why we say 50K is the number. If you're not at least 50K, go higher if you can. Go to 100K. Okay? But basically, when you're investing, you've got to look at what am I actually going to make? How long will it take me to recuperate my capital? Right? So that's, again, capital, clothing your capital. Do you have enough capital to clothe? And before you look at do you have enough capital to clothe, you got to ask, have I even clothed myself? Have I been running around naked this whole time? Right? So clothe your capital. Do you have capital to clothe? Have you even clothed yourself? Now, this goes back to one thing that I'm going to start here. Your best investment will always be you. Anyone that tells you otherwise is trying to pitch you their deal. Or they just don't believe in you, which is still trying to pitch you their deal.
Or they're very confused.
Or they're very confused and they're trying to pitch you their deal of confusion, okay? So you are your best investment, meaning if you haven't maximized your own personal development, why would you put your money into another asset? Okay, my best investment, guys, was Cardone University. I spent $995 on Cardone University. It took my income that year from $50K to $500,000 over a 24-month period. There's no way that I'm going to do that with a real estate deal. There's no way I'm going to do that with Bitcoin. There's no way I'm going to do that with a mutual fund. So if you haven't clothed yourself, meaning you haven't invested in yourself, you should not invest in other assets. It's a slap in the face to your own potential to say, I trust four doors and or four walls and a door more than I trust my own ability to produce. Okay, so this is really like where I want to preface this whole thing, and now we're assuming you're at the point where you're ready to invest. You're ready to invest. You've clothed yourself. You've invested in yourself. You've increased your income. You've got surpluses. You've been saving 40%. You've got 50K or more set aside. Now we're looking at, where do I put my capital? How do I clothe my capital, right? Now there's two categories here. There's income producing assets, and then there are appreciation assets. I put two arrows because it's a scale. Because you could have some that are more income producing, you could have some that are less, some that are in the middle, some that are more focused on appreciation but still get some income. So you got to realize, where do I want to be on the scale? Okay? Right now, you're in cash. If you're in cash, you're in the middle. Okay, you're not appreciating and you're not producing any income. That's why we do the sacred account. You can be in the middle and still get some income and appreciation without having to give your money away, right? So you're in the middle and you're looking at, which one do I go to, all right? And with investing, there's a couple rules that we follow. Number one, never lose money. Okay, so that's the first rule you got to follow. Number two, never invest in something you don't understand. Number three is cash flow. Okay, and then after that, we're actually looking at security. And this is different than never lose money. Security means, if something bad happened, do I actually hold an ownership stake in an asset? Okay, that's why we structure all of our deals that way. Okay, we're looking for never lose money. Okay, so that's where we do, all right, we're going to get a debt-based investment. We're going to lend to somebody. They're going to pay us. We won't lose money on that. If I invest in a business venture, I could lose money, right? So never lose money. And then we're now looking at understanding the investment. Okay, most of our clients, if we said go do a real estate deal, they wouldn't understand it, right? Nano, you see when people look at cap rates, NOI, all that stuff, it just glazes over. So, like, we're looking at, is it simple? Okay, and the rule on this is, guys, it's called the napkin rule. If you cannot draw it on a napkin, it is not a good idea. Okay, if you cannot draw it on a napkin, it's not a good idea. And this goes back to, I went to a course, when was this? 2016. You guys know Gary Keller? Keller Williams Realty, the guy's a billionaire. Yeah. So he had like a core group of like top like brokers and stuff, and he told them all, hey guys, I need a business plan from you. They drew all their business plans up, put all this time and effort into it, brought it to the table, like we're talking like 7, 8, 9, 10 pages. He told them, throw that out. If your business plan takes more than 1 page, it's not a business plan. So same simplicity goes here. If your investing plan can't happen on a napkin, it can't happen on a piece of paper, you can't make sense of it and draw it out and demo it, then it's not a good idea. Okay? Next is cash flow. Okay? So you want income. And the reason why you want income is you're going to take that new income, you're going to keep saving it and saving it and saving it up to the next investment. It's called compounding cash flow. Okay, it's the debt snowball, but in reverse. You're earning the interest. You're getting the cash flow. It's growing and it's purchasing more assets, right? And then the next one is security, right? Security. This is why I like private lending. This is why I like life insurance. This is why I like bullion. I want to have something. Okay, so if my deal goes south, let's say it's private lending. I own the asset. Lexi lends me the money for the asset. I buy my thing, and I pay Lexi interest now. Simple as that. I pay Lexi interest now. If I don't pay Lexi interest, she takes my thing away. So as an investor, Lexi has security because she can keep the thing. At the end of the day, she has collateral. Okay, so you want to look at that. And then at the bottom, we're looking also at 5, you want to have tax benefits and appreciation. And the reason why appreciation is last is because appreciation is a mirror of inflation. Doesn't mean anything went up in value. It means the dollars became worth less. So all it's saying is you bought the marker for $1. Now the marker costs $10. It doesn't mean the marker is $9 more valuable. It means that the dollar that I bought is now 10 times less valuable. Okay, so these are the things you're looking at. These are the rules, and you want to make sure you follow those rules. Now, when we break down the two different ways here, okay, we have income producing, we have appreciation. Income producing means I buy the thing pays an income, like we said, it pays interest to Lexi. That's income. And because of that, I never have to sell the thing. It's the golden goose. It lays golden eggs. I'm going to keep harvesting the eggs. I'm going to keep getting that out of my asset. Now, the appreciation is I buy the thing, and I hope the thing goes up in value, and I hope I can sell the thing to another person at a profit, and I hope that I can live off that profit and I don't run out of money. That's appreciation investing. Okay? The risk here is a couple things. Inflation. So if inflation happens, you can't control how fast that thing goes up in value. The other risk here is you've got to sell the asset once you get it. And then, basically if you sell the asset, you're out. You're done, right? And then on the income one, you don't have to sell it. There's no risk of running out. If inflation goes up, Lexi can say, hey, Jerry, it's a variable interest rate. I've got to raise my rate because it costs me more to have this money out there. Okay, you want that, right? So when we look at different types of investments, I want to break a couple of them down. In the appreciation category, the first one I want to start with here is mutual funds. All right, and we talked about gradient scale. Mutual funds can appreciate, but they can also produce a dividend. Okay, and a dividend basically is a surplus left over, and the company decides to release that to the shareholders, and the shareholders get an income stream. So you can have, appreciation is primarily where you get your return, but there's a little bit of income, which is why we're not all the way over here, right? All right, so what is a mutual fund? A mutual fund is going to be stocks and bonds. It's going to be in a basket. Okay, so it's basically packaged into a fund. You have a fund manager. Some companies have 1, some companies have 3, some companies have 12 or 15 for that fund. And basically with the mutual fund, you're hoping, there's that word again, you're hoping that your shares go up in value. And you're hoping that you can sell those shares. And you're hoping that you can make a profit when you do that. And you're hoping you made enough profit to either reinvest to buy more shares or to live on, right? Now, typically with mutual funds, let's say, healthy return, let's say you're making 8%, right? That's what's advertised, right? 8% is the gross return. Okay, so 8% does not include, you've got annual management fees. You've got what's called a front end load. Okay, so when you buy a mutual fund, you're typically going to pay on the front end. That starts at a 5.75% fee on most funds, and it goes down as you put more money in. And then you've got an annual fee, which is typically going to be about 1.25%. Okay, and then you have different transaction fees, low balance fees, etc. Okay, and those are usually fixed dollar amounts. And then the one that not a lot of people realize, guys, is called fund turnover. And this one is big. You've got to know about it. It's not a fee, but it actually causes a taxable event within your fund, even if you don't know about it, okay? So turnover would be like this, guys. So if I had a mutual fund full of stocks and bonds, and let's say I've got 100 stocks in there that I've picked out, hand selected. If I decided, even if I kept my mutual fund, and my fund manager decided I'm going to pick this stock and get rid of it out of the fund, if he made money when that happened, that's called turnover. Okay, if he did that in a 12 or less month period, I'm going to pay income tax on the gain, even though I didn't sell my fund. Okay, if he does that over a year, it's going to be capital gains tax. So I can be taxed on my mutual funds even if I wasn't the one that sold, because I'm not in the driver's seat. Money was made, I own the thing. That's called turnover. So turnover is not good. Okay, turnover drives up costs, it drives taxes up, right? So the other thing with mutual funds you've got to look at, again, it's the appreciation model. So you have your value, and then you also have your income. It's important for you as an investor to know the difference between value and income. Value is what would I sell it at the end of the day at net asset value on the market, and that's going to be a sale. Okay? And I want you to realize most of the returns reported on mutual funds are from this. It is not from income. It is from the sale of the share. It is from the sale of the share itself, and that's going to be where you see most of your return. The income is produced by what we said was the dividend. Okay? And a good growth mutual fund with income will probably produce a 2 to 3% annual dividend. Right? 2 to 3%. But what did we say? There was a 1.25% fee. Okay, so let's say it's 2%, because 2%, like 3%, 4%, that's if you're buying like really high, like blue chip, really high dividend paying stock. If you do like the average fund, probably going to be like 2%. If you looked at the S&P right now on the DQDGA website, that's going to be probably about 2% over whatever last 15, 20 year period would be. Okay, so if you have 2% and you're going to pay 1.25% in fees, what did you actually have left? 0.75. Okay. So let's say that my goal, Nano, what's your retirement goal, Nano? How much money would you like per month when you retire?
I don't know if that's never going to come one day, but within the next 10 years, I would say 32,270.
32,270. Okay. So Nano would like $32,270 per month from his investments. All right? So Mike, do you want to calculator it up?
Yep.
Okay. So 32,270 times 12
387,240
divided by 0.0075.
51,632,000.
All right, so $51 million. All right, so at the dividend rate, the net dividend rate of what we said was 0.75% after fees, Nano would need $51 million in mutual funds to produce that. Can I sell you one, Nano?
Who the hell would buy that?
Can I sell you one? Come on, man. So that's mutual funds, guys. Now, the reason why mutual funds are sold is the fees. Okay, so you might make 8%, and I want to spin it to you like this. Okay, you might make 8%. So you're gonna loan me your money. I'm gonna maybe go try and make 8%. Okay, you loaned me your money. Let's make sure that that's the concept that we have down first. You gave me your money. Now, for you to loan me your money, I'm going to charge you 5.75%. How much sense does this make so far? Would you do the deal, Mike?
Nope.
Okay, I know you don't like that part, okay? But, hear me out. I'm going to go speculate in the market, hope I can make some profit, be sweet if I do. And for me to do that, I mean, I can't guarantee I'm going to do it. That's the thing. Let's be honest here. I can't guarantee it, all right? So if I make the money, you can have your money, the return on the money, right? And then if I don't make the money, I'm sorry.
Give me some more.
We're just SOL.
Well, I guess the typical validation for that is most people are like, well, you have to be willing to lose some money to make some
You
money.
have to be willing to lose some money. That's like you have to be willing to break your heart before you get married. Doesn't make any sense, right? So, Mike, I'm going to speculate. I'm going to try and make 8% for you. You're my boy. If I do, you can have the 8%. If I don't, I don't know what to tell you. Can't give you your money back. You can't ask for it back.
He would actually have 2.25, which will be the difference.
The difference. Okay? So Mike's going to do that deal, right? Are you doing that deal? Mike's not going to do that. So I know you don't like that rule, but let me tell you what. There's a guarantee. Okay? You want to hear the guarantee?
The annual fee.
The guarantee is you will pay me 1.25% a year no matter what. even if I lose your money.
So where's that money come from though? If you lose the money,
If I lose the money, what do you mean?
Is it a negative fund at that
Well, I
point?
mean, if you gave me 50 and let's say you gave me 50 and it drops down to 25,000, I can't give you the 25,000 back, but I'm going to take a 1.25% fee off the 25K that's left.
The money that you already lost, not even the money that you lost.
Yeah, on the money that's left. I lost the 25. That's gone now. I got paid really well while I was doing it, though. We in? Sign right here? Sir, what do you need to think about?
So how is it 575 plus 125?
So this is your front end fee. So when Mike puts in 100,000, or that would be a bad example. When Mike puts in 10,000, he's going to pay me $575 to be able to put the money in.
From the get-go.
From the get-go. Before we do anything, he's going to pay me that just for the privilege of putting his money in my fund.
Crazy.
Is that real?
That's real. That's standard. Okay, the alternative is, this is called a Class A share. Okay, the alternative is, instead of a front-end fee, I just charge Mike a really big annual fee. So I'm going to cut out, if I decided I wanted to go fee-based or like a C share, if I cut this out and I just go annual, Mike, I'm not going to charge you anything, but you're going to pay me 2% a year, bro. No matter what. That's the guarantee. I won't charge you anything, and the guarantee is you're going to pay me. Even if I don't make you any money, you're going to pay me. Do we have a deal now? No? Come on, Mike. This is unreasonable. So that's how mutual funds work, guys. You've either got like retail mutual funds, which is going to be a Class A share. Most advisors won't sell a Class B share. And then Class C shares, which are going to be a higher fee on the back end. Or there's just fee-based advisors that they set their own fee.
Yeah.
And they feel really sophisticated about the fact that they can do that. No one else cares because they're not making me money.
So I guess what's the big selling factor? Why do people get mutual funds? Like I forget because I wanted to get into it when I first started. Like what's that one big selling factor that they're like, oh, mutual funds are the safest things to invest in?
Or why
Yeah.
Uncle Dave recommends that garbage?
So this is where most people sell mutual funds. All right, Mike. This was actually my pitch. You guys are going to see how I used to do this. Because I used to sell mutual funds, okay? So, all right, Nano, I'm going to sell it to you this time, all right?
All right.
So let's say that we're playing baseball,
Okay.
okay? And we're throwing the ball, and you swing, and you crack it. We're your house, okay? And the ball goes through your window, and you have no window panes. What would happen to your window?
Oh.
It will be gone. You'd have no panes. The whole window would be done,
Okay.
right? So that's like buying individual stock. You don't want to do that, okay? But let's say we're playing baseball, and you have window panes, okay? And I crack one out, and it goes right through this pane. What happened to your window?
Still have window.
You only lost one pane. So that's going to be where you're defensive. So by having more panes, you avoid loss. So therefore, the more panes we can have, the better. So if we put more panes in, and this is called diversification, it lessens the chance of you losing money because only one of those gets hit instead of all of them. Doesn't that sound good?
Somebody doesn't know what the hell.
It makes a lot of logical sense, right?
Yeah. Because like, I'd rather lose a little bit than a lot.
Okay, so this is how you would pitch it, and then that's really the big thing. And then the other big thing is called dollar cost averaging. Okay, so dollar cost averaging is something that advisors will sell based on pricing. So they'll say, all right, you never know what the market's going to do, right? So people traditionally, they try and buy high and sell
Low.
okay? Well, you don't know when that's going to happen, right? So for every time the market goes up, it also goes down. It's a gamble, 50-50, you're going to be right or wrong, right? So instead of trying to predict it and buy high and sell, or buy low and sell high, like you can't do that. So instead, you just always buy. Then you get the best of both worlds. And if you put money in every single month, the market's going to keep going up and down. You actually get the best cost per share because you're buying every single month. Doesn't that sound like a bargain? So those are the two main things that make mutual funds attractive for people. The biggest one, though, is, guys, when the 401k came out, that's when mutual funds really blew up. Because mutual funds are what were approved in the 401k. So most people would just, like, you know, it's like you don't know who made the plastic on, like, the inner lining of your car door. But whoever did made a lot of money. You didn't buy the car because of it. It just came with the car. The 401k, you're just doing the 401k because you're supposed to, and here's the funds you happen to get to choose from. Fund company is going to get rich. You don't even need to know who they are. Okay, so people had enough of that going on where it's just like regular, like done, auto draft, auto done every single month, auto enroll. And then finally they start advertising too. So a financial advisor, think of a business model, guys. A financial advisor is a distribution force. They don't look at themselves as a distribution chain, but they're a distribution chain for a company. Okay, I can sell you mutual funds online. I can sell you mutual funds on TV. I can sell you mutual funds through the mail. I can also have a distribution force, a sales force that will go out and make the mutual funds sell for me. So those that are like, oh, I'm a financial advisor. I have 3 letters behind my name and a big old piece of paper on my wall. They're really just distribution for a mutual fund sales company. Yeah. Okay, so this is mutual funds. How are we doing on time, hon?
7:38.
7:38, okay. Do you guys have any questions on the mutual funds? No, okay. So that's going to be, again, mostly appreciation. And I don't want to cover too much on stocks and bonds individually. Obviously, you guys know about stocks and bonds. A lot of the same risks as mutual funds. The difference is you're not diversifying. Usually, instead of paying a management fee, you're paying a commission to buy and a commission to sell. You might pay anywhere from $5 to $35 per share to buy one and to sell one. And this was back, like, when you guys see, like, Wolf of Wall Street and stuff back in the 80s or whenever that was. Like, that's where advisors would make money because they would want Nano buying shares. And Nano, I got a deal on some shares. That's where insider trading came in. Hey, I got some insider information. This company's going to do this merger. The share price is skyrocketing. You should buy 10,000 shares right now. You're going to get rich.
Yeah, it's based off of events that were happening.
Yeah. You guys remember The Big Short?
I don't remember
The movie?
There's even the movie with the Leo. What's his name?
Wolf of Wall Street? Yeah. But you guys remember The Big Short, that movie?
Yeah.
Who was the only person that was okay at the end of the movie? You guys remember? The broker. He was the only one that was okay at the end of that movie. Other than the guy who won, obviously, at the end, he had that giant fund blow up. We're going to have to watch that, Mike. But at the end of the movie, like, all these people, like, the broker would give him hints and tips and advice. Do this, go here. You know, I can tell you what's going to happen. You need to buy this, right? And then at the end of it, he was just making commission. They lost their asses, and he came out with a commission check. That's the financial services industry. That's 90% of advisors. Like, they, even if they don't know that that's what they're doing, realize that they're either doing it unintentionally and they're just following the advice of their mentors and sales managers. And somewhere up the chain, whether it's that manager or their manager, somewhere up the chain, someone knew. And they're like, this is profitable. Let's teach all of our people to sell this. So the guy at the very bottom doesn't even know it's a bad product. He thinks he's doing the right thing because that's what his manager said was the right thing. He's just following instructions. He's being a good person.
Yeah.
So you got to realize that.
Why don't you write it there, like the sacredaccount.com, for people that want to see a different option?
Yeah, so that's a good idea, Nano.
So people can.
Because if I was in the, like on the other end of the of the screen, so I'll probably be so pissed.
So if you guys are watching, if you guys are watching, and I don't expect you to buy this online, I expect you to learn about it, and I expect you to, if you're interested, reach out to us. We can give you more information. If you're watching, go to sacredaccount.com. This is what we do instead. Okay, guaranteed against loss. It's got a 6 to 8% dividend. Your money's not locked up. You can use it whenever. There's no taxes. You can leverage your funds and have them grow in multiple places at the same time. This is one of the strategies of the top 1%. Check this out. It's not a big claim. It's not a pitch. It's something that actually makes sense for you. So go to the link here, sacredaccount.com. If you're interested, we can jump on a call, give you more info.
What are the 4 rules that people need to invest? Never lose money.
Mm-hmm.
Gotta understand.
Mm-hmm.
What was the other 2?
Cash flow.
Cash flow. And the 4th one?
Fourth one was security.
Okay.
Well, you put 5 and 6 on there.
Appreciation and taxes.
Okay.
Yeah. Okay. So guys, go to sacredaccount.com. The next thing I want to hit here really quickly is annuities, because this is, and I I don't want to get into the complex stuff with you guys today. I want to go into the stuff you're going to see the most. Okay? So the next thing here is going to be annuities. Now, annuities are, I'm going to just draw the line right here. Annuities are on the income producing side, depending on how you do them. They could be either, they could be or. Most people do them on the income producing side. All right? So there's what's called like the accumulation period on an annuity where it's growing. Okay, so you've got the growth period. All right, and an annuity is going to grow one of three ways. It's going to grow at a fixed interest rate, typically 2 to 3%. Okay, so it's going to be either fixed, it's going to be indexed. Mike, do you know what indexed is?
It's like already pre-planned, right?
Ish. So it's kind of like, you know, we're going to use the stock market as the measuring stick. And if the stock market goes up, you'll get a percentage of the upside. And if the market goes down, nothing will happen.
Yeah.
You won't lose anything. So it sounds
Put
great.
your stops in.
It sounds great. They're like, hey, I'm going to give you 8. Let's say the stock market goes up. I'm going to give you 8% of whatever the market does on the upside. After the 8%, you don't get anything else. You just get the 8%. Now, if the market goes down, you're guaranteed never to lose money. Best case scenario, you can make 8%. Worst case scenario, nothing happens. Which in theory probably is better than a mutual fund. Right? In theory, like don't lose money. That works, right? Now the problem is the company can change the 8% any year they want to. Without telling you about it, they can just be like, hey, it's 6 this year. So you got to ask yourself, if I'm signing up for an indexed annuity, who is smarter, me or the Fortune 500 company who has analysts looking at the next 10 years of market performance, and they know when they should raise it up and down based on what they know the market's already going to do? I bought it because it was 8. They bought it because they got me now. Okay? So with the annuities, you got the index, the fixed. You also have the variable, which is one of the worst rip-offs in the world. Okay, these are the accumulation models on an annuity. All right, now realize an annuity is an insurance product. So it's not an investment, it's an insurance product. Now it has an underlying fund, so it can have in the variable, it does have mutual funds, which does then make it a security. But if you're doing index or fixed, it's an insurance product, right? So it's going to accumulate one of these ways. Now here's the deal. Once you put the money in the annuity, from a tax status, it's treated like a traditional IRA. Meaning when you take the money out, you will pay income taxes on it. If you take it out prior to 59.5, you'll pay a 10% penalty plus income taxes. Even if it was in Mike's checking account and it was never in a retirement plan, that will still happen if Mike puts money into an annuity. Okay, so you took money that was tax-free, it was liquid, it was in your checking account, you didn't have anything wrong with it, you stuck it into this vehicle. Now you can't use it till you're 59.5, and if you do that earlier than 59.5, you'll pay a 10% penalty, and you're also going to pay income tax when you take the money out. And it grows tax deferred. So it's pretty much going to grow like a traditional IRA does. Make sense? Yeah. Okay, so this is going to grow. Now the problem with the fixed, and here's really what the annuity companies do on the fixed, they're going to give you, like I said, 2 to 3%. The reason they're going to give you 2 to 3% is because they're going to go make tons. And when I say tons, I mean stupid money. Okay, so often what an annuity company will do is when you give them your money, they will buy bonds. Okay, so a bond is a debt instrument used in typically the corporate world or in governments to get money from a borrower. They're going to pay you an interest rate. So the annuity company, they're going to buy a bond. They're going to take the interest from that bond and they're going to do what's called options trading. So they'll buy calls and puts in the stock market. An option is a contract that gives me the future right to buy or sell a stock on a given date before it actually happens. Okay, so I'm actually playing off someone's emotions with option trading. I think I'm buying the contract knowing Nano thinks the stock's going to go up, so I'm going to sell him my contract at a premium so that he has the right to buy it no matter what on that date because that's the date he's speculating. Very confusing, but they do it professionally. So they take the interest from the bonds.
I'm lost.
This is what Garrett does for a living.
Yeah.
Yeah. So they take the interest from the bonds, they buy options. When you do options trading, 30-40% returns is not a big deal. If you're good at what you do there, you can make great returns. Okay? So they're going to do options trading. They're going to make 30 to 40. They're going to pay you 2 to 3. Doesn't that sound a lot like fractional reserve banking?
Yep.
Okay. Now on the index one, like they're going to give you a percentage of the market. This is the same thing with indexed universal life insurance too, Nano. They're going to give you a percentage of the market. Typically, there's going to be a cap rate or a spread rate, depending on the indexing strategy. Realize those words don't matter. They're arbitrary. Somebody made them up as a strategy to create growth in an account that doesn't really have growth. Okay? So again, they're going to go take the premium you gave them. They're going to put that into bonds. They're going to take the interest from the bonds. They're going to trade it in options, and then they're going to get whatever they get, and they'll give you whatever you're owed. Basically a loan to go day trade. That's an indexed annuity.
Yeah, it's funding for them to potentially win.
Yeah, so and then the variable, which is way worse, the variable is just a mutual fund. It's a mutual fund between the annual management fee and then the mortality expenses that are actually attached to the annuity. You're typically going to pay about 3 to 4% annual management fees. 3 to 4%, okay? So let's say the market does 8, well, you paid 4 in fees, so you only made 4%. Isn't that great?
Just barely keeping the purchasing power.
Okay. Now, once they're done accumulating, then they go into what's called the annuitization or the income phase. And if you thought the insurance company made money on the front end, wait till you see how the back end works. So this is called annuitization. Okay, so annuitization means that it hit a certain dollar amount. Let's keep the math easy. You have hit $100,000 and you've decided, I want to turn this annuity, this is how they pitch it, I want to turn this annuity into lifetime income. I'll never outlive my money now. So what the insurance company will do is they will take a percentage of this dollar amount. So let's say it's 8% is usually pretty normal. So you will get 8% for life. Doesn't that sound attractive? Now 8% is not the growth rate. 8% is the percentage of income they'll pay you off your account value. So your account will never grow again. The moment you annuitize, that $100,000 will never grow again. But you'll get paid $8,000 for life. You get paid $8,000 a year for the rest of your life.
How much for the
Just 8.
$8,000 for the year. Typically, you'll get 7 to 9% of your account value guaranteed for life. But when you annuitize, the account value locks in. You will never see growth ever again, and then you'll get paid the income. It's like Social Security. But here's 2 things. Your account will never grow again. It doesn't mean the money went away. Who has the money now? The insurance company. I don't ever get that money again. I don't get $100,000. I get $8,000.
That's for as long as you live.
For as long as I live. So I'm hoping, this is how they prey on broke people. I am hoping that I outlive the 100,000 and I can be like, ha! I beat that insurance company. They paid me more money than I had.
Yeah, how it's worth for us.
They're hoping I die. They're hoping I die, and then that way they don't have to keep paying me. But even if I don't die and I do outlive the money, basically this $100,000 future value of money, what do you think they've been doing with that $100,000 the entire time when they're only paying me $8,000?
put it to use?
They're putting it to use. They're making more than $8,000.
Which means that the purchasing power has gone down by 4% per year.
Nano hit it on the head. No advisor ever talks about this.
Nobody.
The fact that your $8,000 a year will only be worth $8,000 the first year. Every single year after that, yeah, you got paid $8,000, but dude, inflation happened. And you're gonna pay taxes on that money.
Are you
What?
serious?
Yeah.
What? Because it's income?
Yeah, it's income.
So in reality, it's not even 8% when you take into consideration inflation and the taxable income.
It's more like 2%.
Yeah.
So that's how annuities work, okay? So this is one of the reasons we don't sell them. The only time we would ever sell an annuity is when somebody is already in an IRA, they cannot do, let's say, a private lending deal, and they basically need something that's not a mutual fund.
Yeah.
Like, we haven't sold an annuity in years. When is the last time we sold an annuity? Like 2015?
Something
It's
like
been a
that.
very long time. Okay? Now, the other thing I forgot to tell you about, they can pull their money out, right?
They can or they cannot?
They can, if they want to take their money out of the annuity. Now, if they take the money out of the annuity, an annuity has what's called a surrender charge.
Yeah. Remember that one?
Okay, so surrender charge. These can last anywhere from 10 to 15 years, depending on what you bought. All right, so if I'm like, hey, this sucks, I want my money out, I can do one of two things. I can just pull the money out, in which case I will pay taxes and I will pay a 10% penalty, right? Or I could 1035 exchange it to another annuity, which I wouldn't pay taxes. It'd be a tax-free exchange. However, this is typically how these work. So let's say it's a 15-year surrender period. Or let's do 10 just to make it easy. Year 1, year 2, year 3, year 4, 5, 6, 7, 8, 9, and 10. So these are the years, right? So in year 1, if I pull my money out, I'm going to pay a 10% fee. So if I take my money out in year 1, I will pay a 10% fee to take my money out.
On the balance.
On the balance, it's handcuffs. If I pull it out, if I had 100 grand and I pulled out my 100 on year 1 because I realized it's a bad product, I'll only get to pull out 90. Sounds familiar, right? The IULs? Okay, year 2.
IUL was even worse.
Yeah, year 2 I'll pay 9%, then I'll pay 8, 7, 6, 5, 4, 3, 2, 1, and then it'll finally fall off. So if I don't want to pay anything, I have to keep my money there for a decade.
But by the time year 11, so you pulled it out then, it's whatever's money left over.
Well, if it's been growing, I might have made money, right? Because it could have gone up with my interest rate or my index strategy.
This is an annuity where it's locked in, or at least we have an annuity.
We're still in the accumulation phase. Once it's locked in, you can't touch the money.
Okay.
You're done. You gave that money away.
Jeez.
So this is the accumulation phase.
Okay, so say that again.
So once you've annuitized, you cannot pull your money out. So
When does that happen?
I choose. Me, the client, I decide when I want to take income.
Oh, so whenever you decide to take income, you no longer have your money.
Right. I only get the income now. I cannot get my balance back ever again. So that's how an annuity works. Now, here's how good of a business this is. Some insurance companies have what's called a bonus. They want the money out of the other annuities so bad that they will pay the surrender charge to get it. So there's companies literally, they'll pay a 7% bonus. If you sign up, they'll give you 7% on your account value. Because they know most people learn, 3 or 4 years in that the annuity sucks. The reason why, financial advisor sells it to them the first year. They're not on card on you, so they suck at sales and follow-up. Client's getting lonely. Eventually someone's going to come along and take the business. Oh, you have an annuity. Did you know you have this? Yada, yada, yada. You have surrender charges. So then the other annuity company that the new advisor chooses will pay a 7% bonus to cut off that 7% fee to get the money. That's how bad they want the money. They will pay a 7% fee to get that client's money. That's how much money they're going to go make. But clients don't look at it like this. It's all viewpoint, guys. It's all viewpoint. So when somebody sees this as a client, they're not seeing this. They're seeing income for life.
Yeah.
They're seeing never lose money again. They're seeing 8% market participation. They're seeing all of the good stuff. They're not seeing, why would a company pay me money to give me their money?
Mm-hmm.
Why would they pay me to have my money unless they knew they were going to make that money back?
Yeah.
And how can they guarantee me 8? They must be making a lot more than 8 to guarantee me 8. And how do I get out of this thing? And why would they guarantee me income for life when they know that the money could run out and they would have to keep paying me? Why would they do that? And again, it comes down to who is smarter, me or the freaking 40 analysts that work at the insurance company, and it's their job to make sure that the company makes the money and you don't. The actuaries who study human lifespan, and they know to the T when they think you'll die.
Yeah.
So you've got to understand, like, getting into this, you've got the agent, typically is just a pawn. But you got to know who the company is.
Yeah.
The company put this thing together. A board of directors with expert executives, CEOs, COOs, product developers sat in a conference room and said, what is the most viable thing we could sell right now? And they came up with this. So you're not dealing with dumb people that develop the product. You're dealing with dumb people that are distributing the product, not developing the product. Okay? So this is really like, how much time do we have, hon?
It's 7:57.
7:57. So these are really probably the top 2 products you're going to see in the investing space. Okay, you also do have like your life insurances, IULs, etc. We'll go over those another time. But this is a lot of like when you see rollovers, when you see people that have investments that are retail, usually they're going to have either a managed account, they're going to have individual stocks and bonds. These 2 are usually lesser. They're going to have mutual funds, which is primary, and they're going to have annuities, which is also pretty primary. And when you understand how those products work, like the light opens up, right? And a lot of times like they're sold by, and this is again business model, most of the fee-based and brokerage like individual shares that I mentioned, the reason why you don't see as much of those is because it's a higher barrier to entry to sell those.
Say that again.
So the reason why you won't see as many of those accounts is because it's a higher barrier of entry to sell those. So to sell stocks, I would have to get a Series 7 license. That's one of the harder exams to pass. It's like a 3-hour test. So you thought the life insurance test was bad. That one's freaking ridiculous, right? So I've got to be able to pass that. Less people will do that. Series 65, same thing. It's called Investment Advisor Representative. I studied for it. Halfway through my studying is when I was like realizing all this stuff, and I was like, I'm not doing this anymore, right? But that one is also about a 3-hour test. Okay, you're talking about people like that they're not going to go take the test. That means a smaller pool is there, smaller distribution for that product, which means you're going to see it less and less in the marketplace. Okay, now think about the insurance license.
So many.
I know some dumb people that somehow passed their insurance test. It's like, how did you do that? Nano was one. I was one. No joke. We had this lady though. Oh man, we had this lady one time. She passed her insurance exam. I was thinking about this the other day. I was like, how in the hell did she pass her exam? Like dumber than a bag of rocks. Very nice lady, but not intelligent. Like she would like literally just make words up. Middle of a presentation, she would make words up in front of the client. Not even investment words, simple English. She would make words up. It's like you can't even like how did you do that? Like you can't do basic English, let alone insurance English. Lexi's smiling because she knows who I'm talking about. So you think about how many agents though have their insurance licenses. And insurance companies grow faster typically from a distribution standpoint than most financial like advising companies do. So a lot of times your insurance agent is going to sell the annuity because that's what they're licensed for.
Yeah.
Okay? And typically from insurance agent up, the next step is Series 6 and 63. That only allows you to sell mutual funds and variable annuities. You're going to see mutual funds and variable annuities more often. Because the insurance agent's not going to go get their 7, they're going to get their 6 and their 63. Okay? So this is in a nutshell like most of what you're going to see in the basic retail world. And again, if you guys are watching this tonight, you're interested in learning different approaches, go to sacredaccount.com. Okay, sacredaccount.com. And basically we have the 4 rules, right? So like Nano said, rule number 1, never lose money. Actually, that's rule number 2. Rule number 1 was understand. Never invest in something you don't understand. Then we had cash flow. And then we had security. Okay, so the sacred account is very simple to understand. Wouldn't you say so?
Yeah, absolutely.
Now, you're not going to understand it in 2 minutes on a live stream. That's why go to the link. If you go to the link, all of the information is there. We've got videos. We've got actual policies that you can look at. We've got historical dividend rates. So understanding, that'll be taken care of. Okay? Never lose money. The sacred account is guaranteed against loss.
And tax-free.
And it's tax-free. That's a bonus down here, right? Cash flow. You're going to get a dividend. Every single year, guaranteed 4% dividend. But on average, the companies that we work with have outperformed that dividend. They've actually paid an annual 6 to 8% dividend for a century and a half. Okay? And then the last one, security. No matter what, you're going to have money. You're a shareholder in the insurance company. Guys, these companies have billions and billions of dollars. I think Mass like $22 billion in reserves? $22 billion just sitting in reserves.
It's More than the government.
Okay, more than the government. Okay, security, right? So you have security. And then, like Nano mentioned, this actually grows tax-free. Okay, so I don't expect you to be like, hey, I'm going to go buy a Sacred account because of the Facebook live stream. But I do want you to know the link is there, sacredaccount.com. If you want to check it out, you can also DM us. You can hit us up. You can call me. You can go to our website. But guys, make sure that you understand where you're putting your money. I guarantee unless you are a financial advisor or a very well-read consumer, you did not know any of the stuff that I covered tonight. Brand new content, brand new information. Some of you might even own these products and you didn't even know that's how it works. Okay? And you can call BS on me, but we'll find out when you turn 60. And I'm telling you, go get the info, go learn, okay? Go figure it out. If you don't know, go find out who does and talk to them. That's us. So do you guys have any questions? Cool. Pretty crazy stuff, right? Yeah. All right, guys. So we're going to go ahead and tune out the live stream here. Make sure if you watched it, you liked it, you enjoyed it, that you share it. Okay, and we will talk to you guys next Friday, at 7 p.m. again. Go to sacredaccount.com. We'll talk to you guys soon.